All right, so guys, good morning, and this is to clear out the value added statement issue. So the value added statement is a very simple thing. As the name implies, it's called value added statement. So um, this statement shows how an organization creates value. And what we mean by organization creating value is basically with respect to the P&L, you having your revenue and deducting cost of sales. All right. You get what we call gross profit. Then you add all other trading income. All right. Not other income, but other trading income. So how much you add, you're able to generate from your trading activity. So the figure that you finally get here is what we call value added. Now, if there is no other trading income, then it means your gross profit is equal to your value added. So basically, that is that. Okay. So basically, that is value added. Now, the value added statement doesn't show how we get our value, but how we also distribute the value to the stakeholders. And here, the stakeholders are the employees, because they are part of generating the value. The government, we provide the avenue for your business to operate. The shareholders, all right, then the community at large. But there is also reinvestment, like if you have another investment opportunity to undertake. So you are going to share all you have gotten, the value you have gotten, how you are going to distribute all these things. So basically, that is all it's about. And in the value added statement, when you are doing it, the components are the value added, this value added, which is derived by the revenue minus external input, cost of external input. So all those things you do, we call it cost of sales, but the technical name here is the cost of external input. All right. So basically, that is that. So get your revenue and deduct all those things, then distribute it. Good news is that these things are normally done for you in the exam. All right. So all you need to do is to analyze it in terms of how much is going to this how much of this value created is going to. So it's going to the employees, the government. So let's say if here's 10,000, 20,000, what goes to government goes via taxes. Take note of that. Shareholders, it goes via dividend. So let's say it's 30,000. Community, it goes via corporate social responsibility. All right. So let's say that is 10,000. And probably you want to reinvest again. All right. So this one is salary, right? You want to reinvest portion of the money, let's say 5,000. Let's say your value added is 200,000. So how is the distribution done? In terms of percentages, you are going to analyze and say 10 over 200,000. All right, what will be your percentage? So you have 10 over 200. So it is 5%. So you are going to say 5% of the value created is used to sort out issues with salaries, all right, or pay salaries. So that is how you do the analysis. Basically, that is all you need to know under value added. All right, so that is that. The importance of this is that it helps in transparency because it provides to the stakeholders a clear means of how wealth are created and distributed. Okay, so basically that is that. And the stakeholder involvement is also seen, all right, because you are sharing how much you have derived among the stakeholders. So you know that this is the portion they are getting out of the value created, all right. And it also assists in decision making because if you see clearly that these things we are doing is resource allocation. So basically that is that how it enable you to allocate resources. So basically that is that. highlights an entity's corporate social responsibility, especially in these days of sustainability. So this is your value added format. This is it. So like I said, revenue, cost of sales is called cost of bought in material, the external inputs, all right? Then you get your value added from operations, which is this figure. If there is any other income, all right, so you bring them. Take note of that. All right. So all those ones that you have here. So here, this thing is coming from your trading, and the others are coming from all forms of investment that you are making. So basically, that is that. All right. So initially, so you bring in your trading. Like I said, these are trading, other trading incomes. All right. But you can also add other non-trading incomes. Non-trading incomes. All right. So other income. All right. So basically, that is it. Okay. So you just distribute it. All right. You just distribute it. So these are the percentages of distribution. The examiner, he wants you to do the distribution, will give you the figures so that you run it as a proportionate of the other. So that is that. So let's take our illustration. So this is the entity, this is the bought-in material. So you see that the value added and the distribution has been done for you. Okay. So it says that the discussion among the board of directors on the draft figures reviewed wide variations of opinion of usefulness of the value added. So the question will then be about what are the importance of the value added. Okay. So, and it says that some board members argue that the statement of value added is confusing as it is only a reanalysis of a results already shown in the statement of P&L. Another also view that the statement of cash flow is far more important and should be presented instead of the value added. So in the first scenario, you have been asked to draft a report showing the advantages of value added statement. So here, these are your advantages, like we said, the importance. All right. Of course, this question is re-answered. And so you will see the importance. Okay, so it gives a holistic view of value creation, stakeholder focus, transparency, accountability, better understanding of business impact, and add some complementary information that you might not see in the cash flow. So basically, these are things you take a look and you just have a read about. All right, so just that. Then the B part is where I'm interested in. It says that construct a P&L from the information of the value added. So you know how you do your P&L already. There's no cause for alarm. So this is your revenue. So pick your revenue. So this is Yeboah Limited. Ama Yeboah Limited. So you are preparing statement of profit or loss. All right. So you know how P&L is done. So you get your sales. And the good thing is that the answer should always be in the question. This is your final answer. It should be this because at the end of the day, that's what you are going to add. You remember when you do your P&L, you're going to add the profit you get to the retained earnings. So this is your answer, your final answer. So we need to always get to that. So you have sales revenue, cost of sales. So our sales revenue will be 204,052. Cost of sales is 146,028, giving us a gross profit, which I said is the same as value added of 58,024. Then what do you do after that? Is there any other income? Other trading income? No. So you less operating expenses. So what are your operating expenses? So you see there's staff salaries. So those are admin expenses. So salaries, pensions, welfare. All right. There's also depreciation. Okay, so that is that. So that is 15,644, 1,613. Then where is the depreciation, which is part of administrative expense? Okay, so let's add them. 15,644 plus 1,000 plus 613 plus 1835. That gives me 19,092. So this is my admin expenses. This will be tax. This will be other income, other investment income. Addition to this. So basically, this is there's no distribution expenses. So profit before tax will be 5802. That gives me a 38,932. So that is that. Then I need to add. So this is profit before interest and tax. That should have been it. Profit before interest and tax. Okay, so tax and interest. That's operating profit, all right? So investment income comes in to be interest on loan, then interest on overdraft. These are all finance costs. So that is that. They are not investment income. They are finance costs because you are paying two. All right. So your finance cost includes 1120, then 250. So what is that? This is 1370, right? All right. So if I deduct 1370, meaning that there is no sort of other income. I mean, in this case, 1370 gives me 37,562. That is profit before tax. So let's tax. These are all the forms of taxes. Okay, and the total of that is this. So you can break them down. You can also decide to write it once. I mean, you can break them down. You can decide to also write it once. So I'm writing it once. 750. So 2750. That is giving me 16,812. And so this is profit after tax. When you get your profit after tax, what do? You pay dividend. So less the dividend. Remember, that is what you do in your retained earnings. Opening retained earnings plus net profit minus dividend. So dividend is 10,500. So you see the money to retain earnings will be our 6312. So that's the good thing about value added. You know whether you are right or wrong. So basically, this is all under the value added that you need to know. And that so you have to learn how to write your theory. All right. Then this is your value added. Basically, that is that. All right. So now let's conclude with the corporate governance and sustainability aspect of financial reporting. So in Ghana, there is the corporate governance code that is regulated by the Bank of Ghana and also the Stock Exchange Commission. And corporate governance is all about, the word corporate means entity. So a business. Governance is how you steer or direct something. So how you rule over something. So corporate governance simply means how organization is directed or ruled or run. All right. So basically that is that. So the corporate governance in Ghana here, of course, apart from Ghana, we have the UK Corporate Governance Code. And in US, the coming of the Sarbanes-Oxley Act 2002 is also another one for issues on corporate governance. So basically, that is that. Now, uh, we have these corporate governance structures in Ghana, which is about if you have an entity, your board structure. Every company is supposed to have a board. Because if you are going to register a company, you need to have a minimum of 2 directors. These are board of directors, the people who run a business. And according to the code, the one we use in Ghana, every board must have this kind of composition. The board must have a mix of people who have experience and skills and brains, all right, to run the business. There must also be a clear distinction between the chairperson of the board and the chief executive officer of the entity. CEOs are what we normally call MDs, all right, managing directors. Now, but they are distinct from the board chairman. The board runs an entity. An entity is run by a board. A CEO is just a decorated person who makes sure that the board's policies are implemented. So basically, that is that. So take it like Parliament and the president. The people who run the nation is Parliament, and they run it through the presidency. And that is why, in case this nation has to do anything, budget has to be approved by Parliament before the government, the president, and the executive members can start spending their money. So basically, that is that. So there should be a clear distinction between a board CEO, the CEO of the company, and the board chairman. So looking at it in public sector perspective, you are looking at currently Aban Bagbin and Ekufuado, who are one is the chairperson, so the speaker, chairperson of the whole entity, Ghana, and Ekufuado is the president. And it is to ensure balance of power so that when one does something, the other can hold the other one responsible. In terms of rank, it looks as if the chairperson has higher authority, but the person you always see in the office is the CEO. Is that not it? All right. So the board should also have sufficient independent people who are non-executive directors to do oversight responsibilities. So basically, that is that. You need to have a good structure. And you need to also have a committee. Typical one is the audit committee because we are accountants. So the audit committee who oversees controls, they will create controls and oversee them. It is the audit committee that creates internal auditors in an entity. All right. So basically that is that. The audit committee should be made up of it's made up of non-executive directors. We have the executive directors, we have non-executive directors. The executive directors is those ones you see in your office day to day. All right, the directors you work with day to day, but the non-executive directors are behind the scene. They play supervisory and directory roles. All right, so that is that. So you need to have committees like remuneration committee to decide salaries, audit committee, risk committee, nomination committee. All right, and they must meet frequently, a minimum of 3 times in a year. Right. Then we have risk management and control. It is the board's responsibility to manage the risk in an entity. All right. So basically, that is that. And that is why they do audits. They hire people on audits. All right. So internal auditors precisely to see to the internal controls. Then we have ethical conduct and integrity. Of course, all boards are meant to be ethical and behave well. They are supposed to make the entities financials and non-financials very transparent, all right, and engage people, all right. They are also to give us a report on what they do to help the society, which we call corporate social responsibility. These days, we are terming it and bracketing them all under sustainability. How they fare in terms of keeping our environment. All right. So basically, that is that. The food we eat, is it good? What do they do? I mean, how they sustain human life. So the Companies Act, all right, also suggests that every company must have a board. So you cannot have a company without a board. It's not possible. Then you don't have a company. All right. Every company must have a board. It is a law. So ask yourself, where you work, do you have a board? Do you even know the board of directors? All right, find out. All right, so it is very important that you have a board, and it is their duty to avoid every conflict. All right, and to also make directors, all forms of directors, including themselves, to act in utmost good faith and with all diligence. So you remember your early lecture, professional competence and due care. This is it. All right. So, of course, directors are appointed, all right, and they can also be removed. So, the law provides that you appoint directors, okay, through the nomination committee, but they can also be removed. Okay, so you appoint them through an annual general meeting, all right, and you can also terminate their appointment if they behave untoward. Okay, so basically that is that. They have the duty. They have the duty to prepare financial statement. They have the duty to keep the business running. They have the duty to have proper control systems to check the activities of the entity. All right. They have the duty to also manage all forms of conflict. All right. So, of course, the meetings that are between the shareholders and sometimes most of the directors is what we call the annual general meeting. All right. That is where you discuss issues of the company with all the stakeholders, especially the shareholders and the directors. We need to also audit financial statements, part of corporate governance requirements. All right, so that is that. You have to prepare financial statement and an auditor will audit it. Then we have the corporate social responsibility, although not explicitly made mention in the Companies Act, but it is something that every company is supposed to do in terms of giving out to the society. Some argue that giving out to the society is why they pay tax. So the government is the one who is supposed to use the money to do the society building. So a company, why should a company that is paying tax give to a hospital again? Then what is the government using the money for? All right. It is said that even the sea that is there still accepts the rain. So I mean, it is not bad if you still contribute to it. All right. According to the governance concept, you are supposed to also protect the rights of shareholders. Okay, so they are there. You are there because of them. So protect their right. Right. So that is that. Their right to collect dividend, attend and vote on meetings. All right. All those things are also talked about. Now we come to corporate governance disclosures. Companies are actually required to also disclose. In fact, how much they pay training their directors are supposed to be disclosed. Everything. And most importantly, the activities that they do. So the impact of what they do on sustainability. We are facing galamsey issues. And it is said that all those people who are doing galamseys are entities. They have license, concessions, they are licensed. My question has always been that it is, do they report on what they do? How what they do affect the society? Because sustainability is now becoming a requirement in IFRS. So you have IFRS S1, IFRS S2. Do they disclose them? If they disclose, we will know. All right. So that is that. So sustainability and climate risk are becoming increasingly significant factors in preparing financial statements because you need to disclose them. How you pollute the society must be disclosed, and how you are giving out to the society to help deal with those ones too must be disclosed. If these things are disclosed, and for example, Ghanaians are readers, then they should not buy from companies who are destroying the environment. So the disclosure is very important. So if you disclose and we get to know that you are destroying the environment, but also probably you are giving out to support how to curb the environment. So that one, at least we can manage it. But if you disclose, you are supposed to disclose, and we also see that you are not contributing equally to the environment to curb it, then it means that people should not even buy from you for you to continue having money to do what you do. All right. So basically, that is that. That is that. So there has to be disclosure. All right. Even disclosure on your asset valuation. There are risk, impairment on asset. So you know that when your asset is getting to the end of useful life, it is a distraction to the society. So how they are impaired, the climate risk can lead to a reduction in the value. For example, we started using a specific type of car. Right now, we are having a chargeable cars. So it is going to cause impairment in all your cars. Yeah. So when we make environment regulations strict here, all right, very strict, and we also because of the risk associated with using some machine, it will definitely affect your asset. So the sustainability issues that we are bringing up will affect, just as I was saying, that if people don't buy from these entities, it's going to affect their revenue. Exactly, it's going to affect your asset. Climate change will affect some because of the way the systems are going. Very soon, even an umbrella will become a liability because the way we are destroying the environment and the sun is scorching, you will be putting umbrella on you and it will be causing heat even on you. So basically, that is that to cause people not to even buy the umbrella anymore. If it is raining all the time, we realize the umbrella is not even solving the situation. Then you have to get raincoats. So all these things affect, and it even affect the fair value. Of course, one of the issues is decommissioning costs, right? Restoring the land to its usable state. So if you destroy the land because you are mining, extracting oil and those things, the accounting implication is that you have higher provisions of liability to pay. So basically that is that. And also contingent liability. So sustainability have its way of getting into our financial figures, and that is what we are discussing. All right. So basically that is that. It affects your assets through impairment and fair value measurement. It affects your liabilities through provisions of decommissioning and environmental liabilities. You've seen this thing in PPE all the time. It's not anything new. All right. And also because of that, if you have court cases because you are causing environmental damage, then it means you've been having contingent liabilities to disclose. I've already talked about the revenue because it affects revenue. All right. It affects revenue. So that is that. It even affects customer preference. Like I said, some ethical people will decide not to buy from you. Basically, that is that. Then we have how it affects your operational expenses. It increases your cost because there's an additional cost you have to incur. For example, your CSR, you have to do it because you are the same person destroying the environment. And these days, where the world is going, everybody must invest in technology. It is your